Welcome back to the deep dive. We've got the Invesco Q3 2025 earnings call and presentation you sent over. And wow, this isn't just your standard quarterly update.
No, not at all.
We're really looking at a major strategic overhaul happening right alongside some, frankly, record-breaking numbers.
Exactly. They hit $2.1 trillion in assets under management, a record high.
Which is huge.
But at the same time, they're making these pretty significant changes to their global structure. It's like doing open heart surgery while running a marathon.
That's a good way to put it. So for anyone tracking the asset management world, this isn't just numbers on a page.
Right. You could see this as Invesco laying out a pretty clear roadmap. They're simplifying, they're selling off pieces, refining platforms, all to zero in on what clients want now.
And especially clients outside the U.S., it seems.
Yeah, that's a big part of it. It's all geared towards, future profitability.
Okay, so our mission today, pull out the key numbers, figure out these divestitures, understand the strategic plays. Basically, how is this massive organization positioning itself?
And by the end, you should have a really good sense of what's driving their growth now, and maybe more importantly, what they're giving up today to boost those margins tomorrow.
All right, let's dive into the performance first. The headline numbers. It's a really strong quarter. Good markets helped, obviously, but the flows were impressive.
Absolutely. That $2.1 trillion AUM figure is the big one, a record.
But AUM can just go up with the market, right? What about new money?
That's the key. They pulled in $28.9 billion in net long-term inflows.
$28.9 billion. Wow.
Yeah, it's their best flow quarter since way back in 2021. And crucially, that translates to a 7.9% annualized organic growth rate.
Okay, 7.9%. So that means they're actually gaining market share, not just riding the wave.
Precisely. It's real growth.
So they've got this massive $2.1 trillion base. They're adding new money. How does that translate into better profitability? You mentioned leverage earlier.
Right, operating leverage. It was pretty powerful this quarter. You saw the adjusted operating margin hit 34.2%.
34.2, and that's up from last quarter.
Significantly. It's a 300 basis point jump, quarter over quarter.
300 basis points, so a full 3% margin improvement. That's substantial.
It is. And the number that really shows how they did it is the operating leverage itself. 480 basis points sequentially.
Okay, explain that 480 number. What does that really signal?
It signals that as the revenue came in, partly from those huge inflows, partly market lift, their costs didn't rise nearly as fast.
Ah, okay.
So they managed their expenses really tightly, even as the money poured in. That difference, that efficiency, drops straight to the bottom line. It's exactly what you want to see in asset management. Scale working for you.
And it wasn't just one type of product driving this, right? The growth seems pretty broad.
Very broad. Flows were positive in active, that was $6.9 billion, and also in passive, which was the bigger chunk at $22.0 billion.
So strength in both areas.
Yep. And geographically, too. It wasn't just one region carrying the load. Asia-Pacific was actually the leader with $11.4 billion.
Interesting. Ahead of the Americas.
Yeah. Americas was next at $9.6 billion, and then EMEA, Europe, Middle East, Africa brought in $7.9 billion.
So growth everywhere.
Pretty much. And this is important. Nearly 40% of their long-term AUM now comes from clients outside the U.S.
40%. That diversification must help cushion them against, downturns in any single market.
Exactly. It builds resilience.
Okay, now for the more surprising part. While they're hitting these records, they're also actively, almost aggressively, cutting pieces away, simplifying things.
Yeah, this is where the strategy really comes into focus. It's about honing in on that core investment management business. 2 big divestitures announced.
Let's start with the first one, Intelliflo.
Right. That's their cloud-based practice management software, not really core asset management tech.
Makes sense. So they're selling it off.
Yep. Expected to get about $100 million in net cash when it closes in Q4. There's also a potential for $65 million more down the road in earnouts.
Okay, $100 million cash up front. Nice boost.
Yeah.
But I saw something about an impairment charge related to this.
You did. They took a $36 million non-cash charge in Q3, basically writing down the value on their books to get it ready for sale.
So a bit of accounting cleanup before the cash comes in.
Exactly. And they said the ongoing financial impact of Intelliflo was pretty small anyway, so this is just about getting value for it and moving on, sharpening focus.
Okay, the second one seems maybe counterintuitive. Selling a majority stake in their India business. Isn't India supposed to be a huge growth market?
It is, but this isn't quite a full exit. They're selling a majority stake to the Hinduja Group to form a joint venture.
Ah, a JV. So bringing in a local partner.
Right. Hinduja Group is a major local player. This gives Invesco that local expertise, distribution power, things that are really crucial to succeed long-term in a market like India.
So they get cash now and a strong local partner. How much cash?
They're expecting somewhere between $140 million and $150 million, also in Q4.
Okay. And they still keep a piece.
They keep a 40% minority stake, so they still benefit from the growth, but they don't have the day-to-day operational burden in the same way.
How does that show up financially going forward, that 40% stake?
So India AUM, which is almost $15 billion, that comes off their main operating results, no longer consolidated.
Got it.
Instead, their share of the profits from that JV will show up below the operating line in equity in earnings of unconsolidated affiliates. It becomes more like a financial investment return on the P&L.
Makes sense. Less operational complexity, still capturing upside. Beyond selling things off, they're also tweaking things internally.
Yeah, internal efficiencies. A big one was in fundamental equities. They basically took all their global, international, and regional equity teams and put them under one single chief investment officer.
Kind of like they already do in fixed income.
Exactly like their fixed income setup, which has worked well. The idea is to get more consistency, better investment outcomes, and, find those cost savings, boost margins.
And that big tech project, the Alpha Hybrid platform, still moving along.
Still on track. That's the long-term play to consolidate a bunch of different systems onto one platform. Should save costs eventually.
But costs money now to implement.
Right. That's the trade-off. They expect implementation costs to stay in that $10 million to $15 million range again in Q4. The target completion is still end of 2026.
Okay, let's shift back to where the money is actually coming from, those flows. You mentioned Asia-Pacific leading the charge. China JV and India seem particularly strong.
Astonishingly strong, really. The China JV on its own hit a record $122 billion in AUM. That's up 16% just from the previous quarter.
16% in one quarter.
Yeah.
Yeah.
And if you combine the China JV and the India business before the divestiture structure changes things, they pulled in $8.1 billion in net long-term flows together.
$8.1 billion.
Which translates, for the China JV alone, to a 34% annualized organic growth rate. Just phenomenal numbers.
34%. What's driving that in China? Is it all equities?
Actually, right now, it's more led by fixed income plus strategies and passive and ETF products.
Interesting. Fixed income plus.
Yeah, institutional money favoring that stability, it seems. Demand for active equity in the region is a bit slower currently, but they're positioned with their passive stuff and obviously hope active picks up later.
That strength in passive ETFs in China, it kind of mirrors their global picture, doesn't it? Their whole ETF and index business just hit a massive milestone.
It did. The entire ETF and indexed offering, including the famous QQQ, crossed $1 trillion in AUM.
$1 trillion just in ETFs and index funds.
It's a huge part of their business now. That segment alone brought in $21.4 billion in net inflows this quarter. That's a 15% annualized organic growth rate for ETFs.
15%. So is there a risk here? Becoming maybe too reliant on passive? Or are they doing things to balance that?
That's the strategic question, isn't it? But they are definitely innovating within ETFs. They're focusing heavily on active ETFs.
Active management in an ETF wrapper.
Exactly. 65% of the ETFs they launched this quarter were active ones. They now have, I think, 36 active ETFs just in the U.S., holding around $16 billion. So they're trying to blend the best of both worlds.
Okay, shifting to traditional fixed income, the fundamental side. How did that look?
Pretty solid. $4.1 billion in net long-term inflows into fundamental fixed income.
$4.1 billion.
But here's where it gets interesting. If you add back the fixed income flows from ETFs and the China JV fixed income assets, that total fixed income flow number jumps up to nearly $13 billion.
$13 billion. So fixed income overall is still a huge driver.
Absolutely. And they're seeing a shift in how clients are using it. People are starting to move money out of the very short-term stuff.
Like money market funds or ultra-short bonds.
Exactly. And moving into intermediate and even longer duration bonds, kind of locking in yields now, maybe anticipating rates might eventually come down.
Makes sense. One area that seemed strong but maybe a bit different was the U.S. Wealth Management SMA platform, separately managed accounts.
Yeah, that was interesting. SMAs are usually quite high-touch, personalized.
Right. Seems different from the big global scale focus elsewhere.
It does, but it shows they can do both. This SMA platform is clearly resonating in the U.S. wealth channel. It's highly scalable digitally, even if the service feels personalized. AUM hit nearly $34 billion.
$34 billion. And the growth.
Growing fast, a 19% annualized organic growth rate. So it's a really important engine for them, specifically tapping into that sophisticated U.S. advisor market. Diversifies things a bit.
Okay, and quickly, private markets. Anything notable there?
Modest inflows, about $600 million net, mostly private credit and direct real estate.
Okay.
The bigger news there was launching the first product from their new partnership with Barings. It's an interval fund, the Invesco Dynamic Credit Opportunity Fund aimed at the U.S. wealth market.
Bringing private credit access to advisors and their clients.
Exactly. And MassMutual is backing that whole Barings partnership with $650 million in capital commitments. So they're definitely building out those alternative non-public market capabilities.
All right, let's talk about the balance sheet and how they're using their cash. They seem really focused on paying down debt.
Very focused. Remember, they took out those term loans earlier in the year for that preferred stock repurchase.
Right.
Well, they've already paid back $260 million of the $1 billion borrowed, and they're actually accelerating the repayment.
Accelerated?
Yeah. They plan to pay off the remaining $240 million of the shorter 3-year loan by the end of this month, October 2025. That's ahead of schedule.
And using operating cash flow to do it, not more borrowing.
Purely operating cash flow. It's a strong signal of confidence in their cash generation, and it's improving their leverage ratios, too. The main ratio, excluding preferred stock, is down to 0.63 times.
Okay, so deleveraging is a priority. Does that leave room for returning cash to shareholders? Buybacks, dividends?
It does. They bought back 1.2 million shares for $25 million in Q3.
Okay.
And more broadly, they've committed to a total payout ratio that's dividends plus buybacks of around 60% for both this year, 2025, and next year, 2026.
60% payout. That's pretty clear guidance.
Yeah, the strategy seems to be clean up operations, pay down debt quickly, and then consistently return a good chunk of earnings to shareholders.
Okay, last big piece. The QQQ modernization. This conversion has been a hot topic. They had to adjourn the shareholder meeting. That sounds potentially problematic.
It can sound that way, but it seems more procedural here. They pushed the meeting to December 5th.
Why?
They get more time to solicit votes and reach the required quorum. They were pretty clear that the votes already cast are overwhelmingly in favor.
So they think it'll pass, they just need more shareholders to actually vote.
That seems to be the message. It's an administrative hurdle, getting enough participation rather than a sign of opposition. But yeah, you never like to see delays on something this important.
Assuming it does pass in December, let's talk about the financial impact. The fee structure looks like 18 basis points for managing the money.
Right, 18 basis points for the investment management fee.
And then about 12 basis points go out the door for third-party costs, like licensing the NASDAQ 100 index.
Roughly, yes, for licensing, admin, those kinds of things.
So the net revenue benefit to Invesco is the difference, about 6 basis points.
That's the top-line revenue benefit, correct, around 6 basis points.
But then they mentioned a different number for the impact on operating income, closer to 4 basis points.
Yeah.
Why the difference? Does that mean it's less profitable than it looks?
Ah, good catch. No, it doesn't change the actual profitability. It's purely an accounting thing.
An accounting thing.
Yeah, basically the SEC reviewed how they were booking QQQ marketing costs. Previously, those costs were netted against those third-party expenses we just talked about.
Okay.
Now they have to reclassify those marketing expenses and report them separately on the main marketing expense line on the income statement.
So the money is still being spent on marketing. It's just showing up in a different place on the P&L.
Exactly. It's a reclassification. Doesn't change the net operating income impact at all. That bottom line benefit is still expected to be around 4 basis points of QQQ's AUM. The story is the same, just presented slightly differently per SEC guidance.
Got it. So wrapping this up, it feels like two big forces are shaping Invesco right now. You've got strong markets lifting everything up, record AUM.
Yep, the market tailwind is definitely there.
And then you have this really disciplined, maybe even aggressive strategic simplification going on. Selling businesses, cleaning up systems, consolidating investment teams.
Absolutely. They are laser-focused on unlocking that future profitability, expanding margins. Every move from the India JV to reorganizing equities seems geared towards building capacity and making the business more efficient long-term.
Okay, so here's a final thought for you, the listener. They mentioned those implementation costs for the big alpha hybrid platform are expected to peak next year in 2026.
Right, the peak spending year.
So the question is, once those costs roll off, and the old clunky systems are finally shut down, what does that really do to their operating expenses and their margin potential in, say, 2027 and beyond?
Yeah. That's when the true benefit of all this current spending and restructuring should really become visible.
That transition, getting through 2026, seems like the final hurdle before we see the full impact of this efficiency drive. Something to keep an eye on.
A great question to end on. The payoff for today's complexity comes later.
We'll catch you on the next deep dive.